everyone. Today is just an absolute wonderful day. We're here to talk about alternative investments. And my name is Stu Turley, President and CEO of the Sandstone Group. I got a nice little team all set up here. Let me introduce Paul Graham. He is our Managing Director over at Sandstone. Welcome, Paul.
Yeah, thanks, Stu. Excited to talk about this.
And then next around the corner, we got Michael Tanner. He is a director of finance over at King Operating Corporation. They're a EMP operator. Hey, thank you for stopping by, Michael.
I appreciate it. This will be fun. Looking forward to talk about oil and gas investments.
And I'll tell you, I'd be dead meat without industry experts hanging around me. So I do appreciate it. And as we get ready for this, we just need to have a bit of an official disclaimer. We are not financial advisors. We do financial research. We do help with digital assistance as far as marketing and those kind of things, but we are not financial advisors. Please talk to your CPA after we give you some great information. So with that, let me go ahead and get started here. And as we take a look, our investors in our group is they take a look at Sandstone and they look for resources. There's the number one search term out there is alternative investments. Just take a look at the chart over my shoulder. It's the S&P 500. It is not doing really well. And the people are really worried about two things: taxes and inflation. And when you talk about taxes and inflation, there's a bunch of problems coming around the corner. What do people do with their money? And so alternative investments really is in real estate. It's in small businesses. It's energy investments. Now, the energy investments can be hydro. They can be geothermal. They can be wind. They can be solar. They're all in oil and gas, and there's special tax advantages for each one of these. And those are some of the biggest questions that we get as market analysts at Sandstone, taking a look at some of those features out there. And so we do have access to all that. Paul, I'm going to throw this over to you as our resident real estate expert that I lean on you very heavily on.
Yeah, I support your weight daily. And really, the reason why I'm so excited for this conversation is that, so my background is commercial real estate and also essentially, building digital products, whether it be websites, SaaS products, data products, the whole nine yards. And so when we combine the opportunity to invest in real estate, which is modern investing, we really see that people tend to go to stock markets or they do a little bit of real estate, right? But there's a lot more out there than just what's meet the eye, even for the very educated and investors within real estate who have been around the block or whatnot are still looking for additional opportunities that frankly real estate can't provide. So it'll be a good discussion today going through the differences between them. Within real estate, there's opportunities to invest in a couple different ways. Some are things like real estate investment trusts, which happen to be on the stock market that typically correlate to the stock market, but your funds are in there, right? And so you have a little bit of, or you have more liquidation potential, and you have, pretty good returns within that. You then have things like private placements that could be for accredited or non-accredited investors. Non-accredited investors are defined as individuals who make 200,000 as individuals or up to 300,000 each year. And then or they have $1 million net worth, right? So those are the accredited standpoints. If you don't meet those thresholds, then you're considered non-accredited. Now, there are private placements that do have non-accredited funds. You just need to have a relationship with that private placement offering beforehand. And so private placements can be in any kind of real estate commercially, right? So maybe office buildings, but most often it's multifamily and self-storage. And these are advantageous ways to get tax savings and other benefits instead of just the real estate investment trust, because those are just like stocks. You're getting a return, but you don't have the advantage of the depreciation, things like that. You could also, purchase your own real estate, but sometimes it's a little tough to scrounge up enough money to buy a $2 million building for you to then manage it yourself, right? So these are all different passive ways to really just have mailbox money for intelligent investors who are non-accredited or accredited. And, I'll have Mike talk a little bit more about, oil and gas investments and the different kinds that, he's aware of, which has just been fascinating to learn about, because it's oil and gas is just more than, putting gas in, your vehicle, right?
I wish it was that easy, man. I wish it was that easy. And today, putting gas in your car, it's getting pretty expensive. No, I appreciate Paul, both you and Stu inviting me on here. Excited to talk a little bit specifically about oil and gas investments. It's probably one of the unsung heroes of the alternative investment space. I mean, obviously, I'm looking behind Stu right now, and the stock market's just got me a little shell shocked here. But if you were to flip that to an oil and gas chart, we'd see something a lot greener, even if we, pun intended, of course. But even if we switch to natural gas, we've seen prices accelerate. There's really four main types of investment vehicles in oil and gas. The first one is very similar to REITs. It's investing in a oil and gas index fund that is, again, tied to the stock market. So it performs fairly similar to the stock market. Now, obviously, your oil and gas index funds are going to be a little bit more weighted towards how the price of oil is doing versus how the S&P 500 is doing. But that's sort of your typical traditional oil and gas investment. Go out and buy it's called the SPDR. I think there's maybe an X there, but basically it tracks and follows and aggregates all of the top public oil and gas players. But that's traditional investments. We're not necessarily here to talk about that, though that is an option for you, again, if you are really interested in sticking in the stock market. But again, we're focused on alternative investments. And there's really three types of investment vehicles within oil and gas that I would consider make up the alternative investment space. The first one, and I think let's start with the easiest two, which are actually the minority of the investments, the limited partnership and the general partnership. Paul just went over what was known as a real estate syndication, which was you as a private person decide to raise $2 million to go buy an apartment complex. That is a private placement, and that could be made up of one investor or multiple investors. And the person who is in charge and managing the property is known as the general partner. It's exactly how it works in oil and gas. The operator of the fund, whoever is raising the money, will actually be, in legal terms, the first purchaser of the oil and gas. That's going to be your general partner, and they're going to get the majority and they're going to get their share of whatever the investment looks like.
Sure.
You see some in hedge funds, general partners sometimes take between 2 and 10% of overall net returns. Oil and gas, it can vary a little bit depending on the exact type of investment the general partner is looking at doing, but generally you're looking about in that range as well. Then the next is the limited partnership, which would be, instead of you acquiring $2 million worth of property, you give $100,000 along with 3 other buddies to go buy an apartment complex with them, and an operator or the general partner is managing that, and you receive distributions, or what we like to call monthly passive income, over at King MPI. That is a limited partnership and very similar to a traditional real estate private placement as a limited partner, where you're investing money, you're not an active manager, but you're receiving some sort of monthly distributions. And that can be done a bunch of different ways in oil and gas, but it's the other vehicle, being a limited partner fund. The most popular oil and gas investment is actually what's known as a wellbore assignment. It's a little bit more technical, but basically what it means is, let's say, for example, there are 10 wells, oil and gas wells, available to invest in. A wellbore assignment says you're getting a specific share of a specific well. And if that well underperforms, your dividends are underperformed. If that well overperforms, your dividends overperform. If they drill a well right next to it, the same company, you don't get access to any of the oil and gas in that, because you have a wellbore assignment. You are assigned a specific share of a wellbore. It's like, imagine being part of a limited partner in a real estate transaction where there are 4 different properties, but you only participate in the dividends from the rent on one of the properties. That would kind of be the analogous situation. So there's a bunch of different types of investment vehicles within oil and gas. Most complicated is that wellbore assignment, but ironically, it's the most used vehicle. But what's very fascinating, and what I'm excited to really dive into as more of a discussion here, is about both specifically the limited partnership opportunities in oil and gas, and why right now is honestly a very, and I hate to say spectacular time, because I don't like to use the term, but a very, very interesting time for oil and gas, and highly consider you taking a look at it as an investor. So those are your main type of vehicles. And as we move on here, I think the most interesting dichotomy between specifically oil and gas and real estate, I know I just spent about 5 minutes explaining to you why they're somewhat similar, but there are some key differences, Paul, and I think this is important for us to highlight here. The first one, is Stu mentioned, tax deductions. In oil and gas, and you're seeing this on the screen right now, it's not a typo. It's not 10%, and we just added another zero on it. That is correct. It is 100 up to 100% tax deductions in oil and gas. And it's very simple. When you buy equipment, when you buy physical equipment, the government allows you to write the majority of that off. And if the investment vehicle you're going with is oil and gas, well, guess what? Oil and gas is primarily drilling for wells. What does it take to drill wells? You got to buy a lot of pipe. You got to buy a lot of rigs. You got to buy a lot of equipment to use to actually drill these wells and keep them maintained. Of the few things that aren't tax deductible, that's acquiring leases, purchasing minerals, which is a whole nother investment vehicle. We're not even talking about acquiring minerals right now. Those are untaxed, or those are non-tax deductible. So when I say up to 100%, if you are in a wellbore assignment, you see 100% tax deductions. If you're in more of a limited partnership structure, you see somewhere between 75 to 90. Again, consult with your tax attorney, but that's generally the range we see over at King, as we actually have two current limited partnership funds open. King Operating Partners Fund 1 and Fund 2 available right now for private placement. And that's where we see about the tax liability fall, because again, we don't go with this wellbore assignment. Paul's going to talk a little bit about real estate, but I think about the actual specific, what makes up the 20% tax deduction in real estate. But there's really the main difference right off the top with real estate, and why I like to mention it first.
Yeah, no, absolutely. I mean, it is a good thing because, again, to your point, oil and gas is similar to real estate in terms of, the passive income, the advantages as the investor of returns, as well as when and how they're done. And then, at some sort of exit point, or maybe refinance, or something of the sort, right? So eerily similar by all means, again, just not necessarily known, which I think, again, just happy to, be here and share more about it. As we think about, real estate and what you can pass through, you can do up to 20%. Right, of a pass-through deduction, and also, including different expenses to offset your income of mortgage interest, property tax, operation expenses, of course, depreciation, and then, repairs. There are a couple nuances to these. So again, this is very much a CPA piece to ensure that you fall within the lines and follow the guidelines of that. But again, if you're really looking from a tax saving perspective, oil and gas is going to be that similar real estate play with that added, advantage. The timeline is going to overlap a little bit. I would say very heavily, in all honesty. However, some real estate deals can last a longer amount of time. Typically, I found it's indicative of the loans that they have. In theory, for commercial property, you're doing, a 30-year loan or some longer term outlook, as well as having a longer term loan. However, that's not always the case, especially as interest rates rise. To produce really good returns to investors, these syndications are going to have to go heavily more towards ARMs, so adjustable rate mortgages. Well, they will take a 3 or a 5, maybe a 7-year type of loan, possibly even 10, to own that property, operate it, stabilize, and then either refinance for benefit for the appreciation, or frankly sell it. Of course, they could sell it at any point, but really the investment strategy when you invest into these types of projects tend to have the threshold of, hey, really we're not going to sell up until this time, or if the offer is not or is above this sort of threshold, right? That way you're ensuring that your investors will receive the type of returns that you initially had conversations with them to begin with. Obviously, these are financial vehicles and there's risk with them, so it's not a guarantee, but it is a possibility based on research. Mike, you want to talk about kind of the time frame within oil and gas, because again, it is similar, but it just depends.
It's very similar in terms of the time frame from a monthly passive income standpoint. Now, a lot of that depends on, and we'll get into this when we talk about why now, and why now for energy, and why we think it's an absolutely slam dunk investment.
Sure.
It does depend on the price of the commodity, both oil and gas. Specifically looking at oil is going to be a little bit more heavily weighted. So when you're checking the prices, look towards oil. It's about a 10 to 15 to 1 ratio between how much you'd have to make in terms of natural gas in order to equate 1 barrel of oil. So that price per barrel of oil is a lot more significant than natural gas, even though natural gas has taken off recently, and that's great. That price per barrel is still holding the weight. In terms of investment time frame, the life cycle is a little bit different than real estate, only because in oil and gas, the objective upfront is to divest. It's not necessarily maybe we'll divest at this point, maybe we'll hold it for long term. No. The goal is to divest. And specifically in these vehicles, you're looking to divest some larger companies, large public companies that you're extremely familiar with, because they're looking for opportunities to drill. They don't want to necessarily spend the time doing the geology. They don't want to necessarily spend the time doing all of the land work. They want to be able to spend some money and have access to tomorrow, bring in their 10 rigs and start drilling and popping holes in the ground. So the time frames are a little bit similar, but I think the objective is a little bit more in oil and gas: divest.
Okay, sure. No, that makes sense, especially as markets continue to rise and to take the peak and really get the maximum returns for the project, as well as the investors who put their money into it.
And that's why when you look at the potential upside,
sure.
on oil and gas, again, not a typo, that's a large spread. That's a 30% annualized spread between, you could get 5%, you could get 35%. And again, all that has to do with how did your wells turn on? Much like if you're buying a short-term rental, you have your forecast on how many people you think are going to show up and rent your place out. Did you meet it? Were you a little above? Were you a little below? Paul's smiling because he goes through that same thing. But we do the same thing in oil and gas, Paul. We drill a well. We say, is it doing what we expect? Is it not doing what we expect? And that happens all the time. Just like in real estate, you're never going to buy a slam dunk property. I mean, they do exist, but they're few and far between. And in bull markets, nobody's selling the prime, no one's selling the best rental property. Everything on the market is a little bit more of kind of what we say the garage sale deal. So it's good, but it's going to need some work into it. We're seeing that right now in oil and gas. With oil prices this high, annualized returns are at 30. I've even run models where you could see 40, 45% annualized returns on anything you put into oil and gas. The part is, where is your oil located? Where is everything? So obviously there's risk, much like real estate, but especially now in oil and gas, there's very little exploration being done, and very few companies, especially like King, that are offering limited partnerships and private placements in oil and gas. Trust me, we're not exploring. We know where the oil is. We're going in known oil productive zones, and we're drilling for quantities in which we're 99% sure there's never a sure thing, but these are fields that produce oil and gas. Trust me. So, the spread is wide, but I think we'll bring it full circle and talk about specifically why in this specific time frame energy as well. I think the thing, and Paul, you can talk about this, what people like about real estate is it's a little bit maybe more predictable.
Yeah. I mean, it's again, similar to the stock market in that thought of the predictability. And then once you go into the private placements, you get those, again, additional deductions and opportunities, and the ability to ride different waves, being, hey, I'm now able to ride the wave that is multifamily as people are struggling to purchase homes, either financially or just simply the ability for homes that are, for sale, right? Supply and demand there. The typical kind of annualized returns we're seeing really within real estate tend to be about that 6 to 12% plus. The key plus indicator is on when you have more of a sophisticated syndication and opportunity where you're taking an asset that is kind of a garage sale opportunity, right? You're then going to rehab and then restructure and then stabilize that asset of which, just like wholesaling, you're getting it at a discount market rate. The tough piece with real estate right now, as a number of, if not every single industry is impacted by, is just the labor and the supplies for that labor to then, come in and restabilize that asset with improvements for the tenants and for the property to ensure that, one, it can be stabilized and rents can go up more to market rates, as well as people want to move into the darn thing. Furthermore, that the appreciation of the property is increased substantially, of which allows the dollar that's invested to go further for their investors. Now, with that being said, there are, times and really investors, when it comes down to it, that want a certain amount of cash on cash return that frankly won't get out of bed for certain levels and certain pieces. And so that's why it's important to consider oil and gas, not only for the upside return, but again, there's that different advantage of that tax deduction for a typical shorter period of time to kind of get in and get out with the actual intention of it. And it's no surprise, which it is timely for why we're talking about this, because energy is a hot commodity as we look towards inflationary rates and a number of other different market conditions. Stu, Mike, do you want to kind of touch on why now is key beyond just hey, oil's more expensive? Well, that seems great, but it's going to fall at some point, obviously.
Well, I'll tell you, Paul, thank you very much. We're in a weird situation, and it's been building for the last 20 years. And what's happened is you take a look at the world has been printing money. And by printing money, whenever you print and you just allocate money out there, it drives inflation up. And so these projects have been building in renewables, which is, by the way, Paul, let's just get this off of this little conversation out of there. It does not matter what power source you use, renewable, solar, wind, nuclear. Let's get the lowest kilowatt per hour to everyone on the planet, but let's use the cheapest electric power generation and make sure it's the least impact on the environment. So that being said, the renewables in Germany, just as an example, have failed. The wind quit blowing and the solar is having a problem. The hydro is failing because they're in a drought. And so when you sit back and take a look, in the US, only 4% of the US is renewable energy right now. The rest of it
baseload electricity.
Baseload. Thank you.
Which is all that matters when we talk about electrical consumption. People talk about, oh, well, I've got a solar panel out sitting in front of my house. No. We're talking about base load energy, and that's critical. So I just wanted to insert that.
Cool.
Thank you very much, Michael. And so when you take a look at base load in the US, 75 or more percent of that is oil, coal, and petroleum. Those three make well more than the 75% in order to just walk into your house, Paul, and turn on the switch. So when you're real
come on over.
Well, we're not transitioning. We're not transitioning soon.
No,
so there will always be a need for oil and gas.
I mean, what do we think about soon, right? Because feds are going to hike rates within this year, right? So soon in the real estate mindset is still this year.
Oh, it's
so what is soon in energy?
They're meeting today. I mean, when we're filming this, they're up in Jackson Hole, and they're talking about right now. Inflation is at 9.5 right now, or 8.5, but it is going up. I've been talking to industry experts all around. And Paul, I also get to talk to industry experts around the world. Just visited with the CEO of a nuclear firm in Copenhagen earlier this week. This morning, I was visiting with an industry expert out of Bulgaria, and then I'm visiting with another one out of South America. So I get a worldwide view of energy. And with that worldwide view of energy, there's two things key that you were asking on. Why is it going to be here? Saudi Arabia has already said they're not able to produce anymore oh, wait a minute, what's up with this? So supply is not gonna be there,
Yep.
which keeps the price high.
But I think the really fascinating part is, what does this mean to the investor? So we've got all this crazy stuff going on with energy.
Right.
Stu mentioned the geopolitical climate going on in Saudi Arabia right now. The Crown Prince came out 2 days ago and said he thinks the market's being manipulated. They're going to restrict output. The fascinating part is inflation's up. Everything is getting more expensive. Interest rates are going up. If you
Right.
look historically, one of the few asset classes that performs well in a recession, yes, I use the R word, even though they took it off Wikipedia, even though now 2 quarters of negative GDP growth doesn't mean a recession. It means it's looking like a recession. I will use the term, we are in a recession. One of the only asset classes that makes a positive return in a recession is energy,
Right.
and specifically oil and gas. If you look at the
Yep.
price of oil versus the price of oil index against the S&P 500, since inflation really hit about a year ago, they're inversely correlated. So that is
Sure.
the critical part of all of this craziness, all of the noise. We always talk about, one of my favorite lines is the signal through the noise. There's a lot of noise, but what's the actual signal that's coming through? Well, commodities perform exceptionally well in times of inflation and times of recessionary impact. So one of the reasons why we like oil and gas investments in general, I don't care if you come to King or not, talk to Sandstone. They have a plethora of energy funds you can go invest to. Part of the reason why King is engaged Sandstone is they have access to an incredible accredited and non-accredited investor base that understand things like this. Oil and gas in a commodities boom performs substantially well. There's a reason when you go back to the earlier slide, I don't know if we can throw it up here or not, but it becomes that 35, 40, sometimes even 50% annualized returns because the price of oil and gas is high. Now, obviously, when the price of oil and gas falls, you see those returns shrink. And one of the best ways to you can be smart, you cannot be smart. Timing of an investment right doesn't matter. You still make money.
Well,
and I think that, Stu's, one of the most interesting and fascinating parts about energy in this environment right now is it's set up to succeed. You can't run a model at $90 oil that doesn't beat anything you find in real estate. Now, on the flip side, it's hard to run models at $45 oil that beat some things in real estate. So there is, we have to acknowledge the risk factor, but we're talking about now.
Yeah.
And Michael, you bring up some great points. And Paul, I didn't mean to step in there, but when
No,
you
certainly.
talk about guys, we've only been in this is the 4th commodities boom
Mhm.
in the history of the world. The first 3, people made beaucoup of bucks. That's a technical
Billions.
term here.
That's Texas for billions, if you're
It's
wondering.
Texas for billions. And they made beaucoup de bucks in the first 3. This 4th one is now different because of the energy crisis that we're in. And Paul, with this coming around the corner, and the Fed is looking at 2 to 3 more times of 50 basis points and 75 basis points
Sure.
with the interest rates going up, there could be some concerns about real estate. And I'm not the real estate guy. I'm asking you your thoughts on this.
Yeah, I mean, essentially, it really comes down to a trade-off for the investor, right? At some point, you just don't get out of bed for things. It's not even that you don't look at it; you just don't get out of bed for it, right? And so, as we see interest rates go up, just you have those deals that are just not going to be as attractive, right? Just like Mike said, when and how those accelerate, we'll have to see. Oftentimes, we really feel certain things 8 to 12 months after certain actions are taken, because you already have cheap money. You've had the cheapest money since money was invented. Not a fact, but just a exaggeration, where now, as interest rates have really climbed this year in specific, then, as we go into next year, you're then going to see, things impacting a little bit more, especially as wars are dragged on or conflicts ensue or supply chains continue to cause concern, specifically around, technology, which then impact a number of different, if not, frankly, every industry as well. So beyond just the commodity and the assets we have, those the working class, as well as the supplies that help support the working class and frankly our entire world structure, are going to be impacted. Certainly there have been, starts of conversations of people of, oh, hey, I'll just hold, right? But one of the biggest things within real estate, as well as, investing in stocks, is dollar cost averaging, right? Where you always want to be in the market. It's just how much exposure you want to receive from the market and how much you put towards your portfolio allocation. Again, why I personally think a diversification into something such as oil and gas is beneficial. So you're not totally swayed into one. 08 and 09 was very painful for some, but extremely, utterly fruitful for others. And so that diversification, helps people in their field. But really, this is more a thought as an investor portfolio decision, maybe conversation with your financial advisor. But I mean, frankly, most aren't going to have that experience and knowledge with investing in oil and gas, which is why talking to operators, or I mean, even someone like ourselves that have experience with working with several operators, is advantageous. Not to say, hey, you should invest in this or put this much money here, right? But it's just more to say, hey, what are your goals, right? Oh, hey, it is, long-term exit strategy. Just trying to wait 3 to 5 years, really before I retire, right? And I'm sick of putting money into my 401k because it's going down, right? Is really the time to have that. And I mean, it seems like if I'm putting these two puzzle pieces together as we come up into the tax year, in addition to how the market's going within energy, as well as how this compares to real estate, now really seems like the time to, for someone to sink their teeth in, if not today, certainly by the end of the year.
Hey, thanks, Paul. Let me just throw this out in closing, if you don't mind.
Yeah.
These are some hard numbers that I was going through here just a little bit ago. Paul, and all your friends out in California, these numbers are probably not a bad thing. Let's say one of your friends that you and I were talking about the other day makes $1.5 million, right? $1.5 million.
It's pretty conservative.
$1.5 million. Do what now?
I said it's pretty conservative on the $1.5 million, but yeah, let's go through this exercise.
Just go through the $1.5 million. $513,164 is your federal tax. Your state tax is $184,557. Your Social Security tax is $9,114. Your Medicare tax is $33,450. Your state disability, which you have to pay in California, is $1,602. Your total tax on $1.5 million, are you ready? $886. Your net income is $758,114. So by my math from Texas, that's 49.5% tax rate, Paul.
There's been a lot of people from the California area who've moved to, I'm in Austin, have moved out here for a variety of reasons. Taxes is one of them. Taxes is one of those things that moves chains and gets you, different lifestyles, because it gets you that ability. And sometimes it's the best way to make money, right? If you can basically, save 20% on taxes, just making an arbitrary number, right? Of that, you reduce it from 50 to 30%. Well, 20% of 1.5, I just got a, fat little bonus, right? And I essentially didn't do anything other than, make an investment. or, you know, have
Exactly.
real estate or something like that. And so as we think about investing in general, returns isn't always the answer. It's also tax savings. And that kind of 1-2 punch is really the left hook to, you know, enjoy a little bit more vacations. So
Paul, outstanding job. And I just really appreciate everything you got. And Michael, thank you for stopping by today. I just get excited talking about real estate and energy and I mean the tax savings and all those kind of things. So thank you guys both very much and look forward to chatting with you next time.
you bet. Thanks all. Awesome. Well, thanks everyone for joining today. So as we think about how you can keep in touch with us, feel free to reach out and start a conversation as an investor. You can also keep in touch with us. We run Energy News Beat as well as Real Estate Investor Pulse, both news sources to get real estate and energy news to you to help you keep up to date on the market. We also lead a couple of podcasts and encourage any thought leaders to reach out to us, maybe collaborate on a number of different pieces, as well as, you know, if you're within the real estate or the oil and gas space looking to raise funds, we do help accredited and non-accreditation funds find investors that have an interest and have funds to invest. We also do a number of digital marketing services, management consulting, and frankly, have fun. We professionally grow companies. Would love to have some sort of conversation with you if you found this information helpful. And if you didn't, I'll leave a suggestion box to hear from you next time. Maybe we'll have you on the show and we can talk about that. So thanks so much again. Include these links and follow through with us.